It may be the most powerful bank in America, but American voters didn't create it. Most people have never seen its boardrooms, never read its minutes, and never cast a single ballot for the people who run it. Yet it decides how much money exists, what it costs to borrow, and how hard it is to keep a job or a home. It began, as most great changes do, with a crisis. Banks failed, credit vanished, factories closed. In a few weeks, confidence itself became a luxury. And in that chaos, one man, J.P. Morgan, stepped forward. A private banker rescued the nation when the government could not, and Morgan is seen as a savior. Congress took notice. If a single financier could save the economy, he could also destroy it. Investigators discovered what they called a money trust. The country demanded reform. So, under the banner of stability, Senator Nelson Aldrich began to design a new framework for American money. Aldrich traveled to Europe to study their central banks. He came home convinced that America needed its own, something powerful enough to prevent future panics but insulated from day-to-day politics. And in late 1910, he gathered a select group of bankers and economists for a secret meeting. They boarded a private railcar under assumed names. Reporters were told nothing. Servants were instructed not to use real titles. At the destination, a private hunting club on a Georgia island, they wrote the first draft of what would later become the Federal Reserve Act. 3 years later, on December 23, 1913, the act became law. The United States now had a central banking system, the Federal Reserve. It would issue currency, regulate banks, and serve as the lender of last resort. For the first time, America's money supply could expand or contract by design, not accident. Yet few citizens understood what had been created. The regional reserve banks were owned by member banks, not by the public. The board of governors would be appointed, not elected. And the institution would have one extraordinary power: to create money out of nothing. When the government borrowed, the reserve could purchase its bonds, conjuring the funds to do so. Every dollar created entered circulation as debt, carrying interest owed to the system itself. For decades, that structure quietly defined the limits of prosperity and the scale of every crisis. The Great Depression tested it. Banks failed again. Millions lost homes and savings. Instead of retreating, the Federal Reserve gained authority, new tools, new influence. World War II followed, then the boom years, then inflation, and finally 1971, when President Nixon closed the gold window. From that moment forward, the dollar was backed only by trust. Without gold, there was no ceiling on creation. If liquidity was needed, it could be printed, or more accurately, typed, into existence. The promise was flexibility, the result was dependence. Through the oil shocks, the debt crises, the dot-com crash, and the Great Recession, one pattern repeated. Each emergency justified a larger intervention. Each rescue concentrated power further. When the housing bubble burst in 2008, the Federal Reserve launched the largest rescue in history. Trillions of dollars in loans and asset purchases. Markets recovered. Ordinary people struggled. Banks deemed too big to fail became bigger still. Economists praised the policy as necessary stabilization. Critics saw something else, a quiet transfer of risk from private balance sheets to the public future. Either way, the outcome was clear. The same institution that promised to prevent crises now defined what a crisis was. By the time the dust settled after 2008, the Federal Reserve held an influence that reached into every corner of the economy. Interest rates, mortgage costs, employment levels, and even the price of groceries all bent toward its policies. The decisions of a few governors could move global markets within seconds. When people asked how this power fit within a democracy, the answer was always the same: independence. But independence also meant insulation from accountability. The Reserve could act boldly, even controversially, without facing an election. Its chair appeared before Congress a few times a year, but real deliberations happened behind closed doors. Inside those rooms, economists debated the value of labor, the cost of money, and the acceptable rate of unemployment. Numbers became policy. Policy became reality. To most observers, it looked clinical. Graphs, forecasts, spreadsheets. To millions living paycheck to paycheck, it felt personal. In 2020, another crisis arrived. A pandemic froze trade and employment. Within weeks, the Federal Reserve expanded its balance sheet by trillions once again. Digital dollars flooded the system. Asset prices soared. Markets roared back long before wages did. The pattern was unmistakable. When danger came, liquidity followed, and with it, greater centralization of control. Over the decades, each rescue had the same side effect: debt. Public debt, corporate debt, household debt. An invisible tether binding present prosperity to future obligation. Yet, few questioned the mechanism itself. The process felt too complex, too sacred, too abstract to challenge. Teachers taught students that the Federal Reserve was created to smooth the business cycle. Textbooks presented it as neutral, scientific, inevitable. But history whispers a different subtext. Every major reform in monetary power, from gold to paper, from paper to credit, from credit to code, emerged only after chaos. Each emergency justified evolution. Each evolution made the system larger and more intricate than before. Some historians see this as adaptation, others see strategy. Whichever interpretation is true, one fact remains: the Reserve's authority has never been reduced. Even when critics call for audits or reform, markets react with panic and politicians retreat. The structure itself is difficult to visualize. 12 regional banks hold stock in the system. Member banks hold stock in them. A central board oversees policy. The Treasury collaborates but does not command. It is public in purpose, private in design. That ambiguity, neither fully governmental nor fully corporate, is its greatest protection. Every few weeks, the institution announces its decision on interest rates. The world listens. Traders lean forward. Headlines refresh in real time. Tiny shifts ripple outward, affecting mortgages, credit cards, pensions, currencies. And yet, for all the sophistication, the questions remain ancient. Who should create money, and in whose interest? Supporters argue that without a central bank, modern economies would collapse under their own volatility. They point to growth, technology, rising standards of living. Skeptics counter that the same mechanism amplifies inequality, rewarding those closest to capital creation. In their view, the Reserve isn't merely reacting to the economy, it's designing it. Both sides agree on one truth: power over money is power over society. From ancient coin minters to medieval treasuries, whoever issued currency set the rules of exchange, trust, and survival. The Federal Reserve is the latest expression of that lineage. Look closer and you'll see the language of faith woven through finance. Words like confidence, trust, belief, echoes of religion describing economics. Because money itself is a collective story, and the storyteller with the loudest voice shapes the world that follows. As technology advances, that voice grows louder. Algorithms now decide when to tighten or loosen credit. Data flows replace intuition. The same math that predicts inflation also predicts human behavior. Some call it progress. Others call it the quiet merging of economics and engineering. Through it all, one institution remains at the center, invisible yet indispensable. Each decade brings new officials, new tools, new crises, but the design endures. It has survived depressions, wars, and revolutions, not because it's perfect, but because no one can imagine the alternative. Maybe that's what real power looks like, the ability to seem irreplaceable. If so, the story of American money is no longer about gold or paper or digits. It's about belief. Belief that a structure born in secrecy now stands for stability. Belief that the unseen hand still serves the public good. And belief that there's no safer system waiting beyond the next crisis. Yet history suggests that every system built on belief eventually faces a reckoning. When trust falters, currency wavers. When confidence cracks, structures tremble. What rises after the fall depends on who writes the next story. For more than a century, the Federal Reserve story has been one of adaptation. But adaptation can also mean self-preservation. Each reform has shielded it from obsolescence. Each explanation has justified greater scope. So the question remains, not one of blame, but of design. If every crisis ends with more authority in the same hands, is the pattern accidental, or is the pattern the point? Whatever the answer, the truth is simple and unsettling. Americans never voted for this power, yet it shapes every paycheck, every loan, every dream of security. It stands between chaos and order, printing reassurance in times of fear. Perhaps that is its genius, or its trap. Because once stability itself depends on faith in the system, challenging it feels like courting collapse. And that, more than secrecy or policy, may be its greatest strength. So when you hear that the economy is strong or weak, when rates rise or fall, when news anchors quote the Fed, remember the origin, an island meeting, a law passed quietly, and a promise that power would never again rest in one man's hands. The story began with a panic, it continues with confidence, and it ends, as all stories of power do, in silence.